Hi, everyone. Thank you for joining us for today's webcast, Luxury, Resilience, Growth, and Valuation Opportunity, sponsored by Tema ETF. Today's webcast will provide one CFP, one IWI, and one CFA CE credit. If you have questions on credit, please give us a call via the number on the console. We welcome and encourage your questions. You can type your questions in the Q&A box, and we'll do our best to get to as many of your questions as possible. Materials, including today's presentation, have been made available from the documents folder at the bottom of your screen. We appreciate your feedback. Please take a moment to take our brief survey that's also located at the bottom of your console. We will cover quite a bit of information during today's webcast. If at any point in time you're interested in scheduling a one-on-one meeting with Tema ETFs, please click the blue confirm button in the media request box on your screen. Lastly, in the event you miss any part of today's webcast or simply would like to watch it again, a replay will be made available, and all registrants will receive that information by email. All right, with that, I'm pleased to introduce our speakers today. Javier Lastra, CFA, Portfolio Manager of the Tema ETF, and Yuri Khodjamirian, CFA, Chief Investment Officer at Tema ETF. I will now turn it over to Yuri to get us started. Yuri, the floor is yours.
Thanks, everyone, and thanks for joining today. So I'm joined today by Javier, who's our portfolio manager on the Luxury ETF. Javier spent about 23 years doing investment research at some of the world's top investment houses, and he's pretty much a consumer sector expert. And what we're going to do is we're going to discuss the luxury sector today. But before we do that, I want to just tell you a little bit about Tema. Tema is focused on thematic ETF strategies. We're backed in the largest venture round in ETFs to date, which was led by two of the best fintech investors globally, Index Ventures and Excel. These companies were early backers of fintechs like Robinhood, Revolut, and Adyen. And we're also really fortunate to have leaders from across the asset management space, from firms like Bridgewater, Aberdeen, UBS, and Robinhood, to be backers of Tema from the early start. Before we get into the presentation, we wanted to do a quick poll just to get your views on thematic investing.
Okay, great. Thank you, Yuri. All right, so we are going to do a poll question, and we appreciate your participation and your feedback. So the first question is, are you looking to add to your thematic exposure today? And the options are yes, no, or maybe. You can select your answer by clicking directly on the screen and then press submit. While we wait for the results, I want to remind you that we will be taking questions from the audience in the end of the presentation. You can type your questions in the Q&A box, and we'll do our best to get to as many of your questions as possible. So that question again is, are you looking to add to your thematic exposure today? And the options are yes, no, or maybe. All right, so we'll give it just a couple more seconds, and then we will share the results. Okay, looks like we've got a good turnout. Okay, so it looks like the top answer is maybe, and I'll turn it back over to you, Yuri.
Well, that's really interesting result because, I mean, one of the reasons we're here talking today is really about what thematics are and how thematics are different, and specifically how Tema's approach is different to thematics. And it's probably captured in these four blocks here. Tema focuses on differentiated, long-term, structurally growing themes. The word differentiated means that there's no other US listed ETF focused on that particular theme. And we use fundamental analysis to define exactly and thoughtfully precise exposure to this theme. And this is because what we found is that indices tend to be quite rigid and backwards looking, and they don't define themes properly. Our ETFs are also managed by experienced PMs like Javier today, who are sector experts, and they use a consistent investment process with risk management to pick the stocks that go into the ETF. And this is really important because in a lot of themes, you often have a large range of outcomes between winners and losers. And it's really, really important to have someone looking at that and picking the winners for that particular theme. The other thing that we do is risk management. And you might ask why. And that's because thematic investing at its very core is really about a risk on trade. And it's very, very important to start focusing on capital preservation before you think about capital accumulation. And what we try to do is we try to focus on eliminating some of the downside risk factors associated with that. And the idea being that if you take care of the downside risks, you can properly capture the upside potential. So kind of on that note, let's dive into the luxury sector. Javier, I just mentioned precision in our approach, and I think that's really, really an important part of thematic investing. Indices often get this wrong because they define the universe mechanistically, and this passive approach means that investors get stuck with a bunch of stocks that actually don't express the theme purely. Now, luxury, that's quite a subjective term, and it's probably quite difficult to define what a luxury company is. So Javier, can you help us out? Tell us what is a luxury company and how do you define the luxury universe?
Yeah, sure. Thanks, Yuri, and good afternoon, everyone. So how would I define luxury? I would define luxury basically by looking at or picking a couple of fundamental characteristics, and I include there words like desirability, exclusivity, craftsmanship, and heritage. But I think one thing that I would highlight as well, apart from those, is the fact that real luxury brands are difficult to disrupt. They tend to be timeless. Think about the reason why you would buy a Cartier watch. It's not really because you need to have your the time on your wrist. Probably your iPhone is much better at doing that. It's not functionality why you're buying these watches. You're buying the watch because of what it means, what the brand stands for, and everything that brings with it in terms of quality, heritage, and how it satisfies your aspirations at the end of the day. I think this we see across the wide range of the luxury space.
That's really interesting. But Javier, just I guess a bit of pushback on that would be that most companies talk about having strong brand equity, especially in the consumer space. What does that actually mean in terms of specifically the luxury sector?
Yes, indeed. I mean, brands exist across consumer goods, but luxury brands are very differentiated. Luxury brands stand at the top end of the range in terms of exclusivity and aspirational consumer brands. I think few brands can claim to share these attributes. Think of Hermès, another key luxury brand in the space, and the fact that many of its key products are actually sold on an invitation-only basis. Actually, I believe that today some stores of Hermès actually work on that basis too. So customers can only get in if they are invited. We might think as consumers that we decided that we chose an Hermès to buy, to buy a product, when actually in actual fact, it's Hermès that has chosen us. Again, there's not a lot of brands that can claim that position and that strength. And this is what really differentiates them from other strong consumer product brands. And the other thing I would highlight is how, in a increasingly globalized world and economy, is how well these brands, these luxury brands, travel across geographies and across categories. So going back again to the example of Hermès, this is a French company that started basically 170 years ago, and they became famous because they were producing these very high quality leather horse saddles. The company is still today producing those saddles, but it is better known for its handbags, the Birkin bag or the Kelly bag. So that's a very good example of how the brand is traveled very strongly across categories. Also, in the case of Hermès, the company started again 170 years ago, selling primarily into the French customer base. If you look at Hermès today, it's totally globalized as a brand. It's traveled through plenty of geographies to the point that around 60% of the sales of Hermès today are sourced from Asia, not France.
I mean, that's super fascinating how it sort of permeates across different dimensions and categories. But Javier, the thing is, you can have business qualities of brands, but ultimately what investors care about is the financial health of these companies. So if you look at the financials of luxury stocks, how do they compare to other businesses?
Yeah, it's a very good question. So luxury companies are amazing at translating creativity and desirability into profitability. This profitability is reflected, as you can see it in this slide, in industry-leading gross margins. Now, gross margins are really key because they provide the fuel for these companies to invest very heavily into marketing and into the brands. That is very, very important. That is the key to the pricing power that these brands are able to command, and it's the key to the equity brand building that we see in the space. But I think also this very high gross margins brings stability. And what I mean by that is basically if you compare luxury goods companies with gross margins of 70%, like we show here in this slide, with companies that may be operating in on very thin margins, in a high inflationary environment where we may see input costs rise very strongly, those companies that operate on thin margins, they normally get forced to make financial choices that are not necessarily in the best interest of the brands or the business long term. That just doesn't happen in the luxury space. So another financial feature that I would highlight is pricing. And here, when you combine scarcity with desirability, you get very strong pricing, which is helpful, as I said, in this current inflationary environment. Luxury brands not only rely on price to drive profitability, but also this pricing is also key to signal exclusivity and ultimately desirability. Higher demand follows higher pricing, and when that happens, we call it negative price elasticity. This is something very exclusive and very particular of luxury brands. And normally the customers can absorb better than what we see in other consumer products industry, this pricing power, because they tend to have a higher income profile.
I mean, it's kind of fascinating to see this sort of pricing power, right? Investors are looking across the market after we've had this bout of inflation to try to see which stocks benefit from this the most. And this is probably one of the most outstanding profiles really relative to others in the sector. And I think the thing that fascinates me the most is that this is a huge market, right? It's about $1.4 trillion in size. And it's been growing really, really fast, not just because of pricing, but because of volume. And I guess one question to you, Javier, is what do you think is the kind of future growth outlook for this market?
Yes, so as you've pointed out, the market has grown strongly in recent years, but even then the addressable market is still growing and we think will continue to grow. We all know about Asia and how that has been a key driver of growth for the luxury market. We do think it will continue to be a very strong driver of growth going forward, but there's also interesting pockets of unpenetrated markets. And here I'll highlight the example of the Americas, where we see a big gap between the percentage of high net worth individuals that are located in that geography and the percentage of luxury goods sales that are actually conducted in that geography. I think there's no coincidence that some of the luxury brands have shown renewed interest in the US market. I guess evidenced in the purchase, you may remember, of Tiffany by LVMH back in 2021. So it's not just Asia. We see some pockets of interesting penetration opportunities, but also there's another big trend that we're seeing and observing, and it's the younger generation. So Generation Z participating in luxury consumption earlier than previous generations did at the same age. And this bodes well for the broadening of the growth across the industry. So touching on the younger generation, this is now already very important in China, which is the fastest growing luxury market in the world. And again, coming back to Asia as a key driver of growth, China is still a growth driver, very important growth driver there. It is expected to become the largest luxury market by 2025. And Greater Asia itself is expected to represent over 50% of the global luxury market by 2025. All this explains in part why we're so bullish about the growth outlook for luxury long term, and why we are less concerned by the potential risk of a short-term slowdown in the US luxury spending. The last point I would like to highlight here, we must not forget obviously about the potential that exists in emerging markets, which is a key luxury growth engine for the next decade or the next 20 years, I would say. There's a large young working aspirational consumer middle class that is growing, and this will play a critical role in expanding the luxury customer base to 500 million consumers globally by 2030. I guess all these factors, coupled with the diversification across geographies and the demographics that favor the industry, that's what makes us positive about the growth outlook, Yuri.
I mean, that's super interesting. I think it's probably time to do another poll, one that's maybe close to people's hearts and homes.
All right, yeah, great. So here's our next poll question. It is a good one. Do you or your family own any luxury goods? And the options are yes or no. And as a reminder, you can download the Continuing Education Certificate of Completion from the folder at the bottom of your screen. If you submitted your CFP or IWI number upon registration, we will submit for CE credit on your behalf to the respective board following this presentation. So that question again is, do you or your family own any luxury goods? And the options are yes or no. We'll just give it a few more seconds. Okay, looks like we've got a pretty good turnout. Okay, so it looks like yes is definitely the answer. So I'll turn it back to you, Yuri.
Yeah, I mean, I'm always fascinated by these kinds of poll questions because I think that's part of the story with luxury, right? It's permeating everything, and it's kind of this aspirational nature of its consumption means it finds its way into every home, no matter really the income bracket that they're in, because people always want to own these goods and have them in their homes and be owned by their families. So kind of summing up, I guess, Javier, you basically said, luxury benefits from unique characteristics. It's got strong pricing power that's sort of superior to other consumer goods. And it's really got these powerful volume growth drivers that should really underpin revenue growth in the future. But how does kind of luxury compare to other industries that investors might be looking at today?
Yeah, so if we look at growth and quality, we see that luxury as it's on its own as a sector really stands out and shares, one could argue, some of the attributes with the technology sector. So namely here we're talking about revenue growth rates and the high returns on equity. However, I would argue that they are different in other respects. And for instance, we think that the risk of disruption is much lower in luxury than it might be in technology, where they can, you can see the changes in technology in a very short period of time. And added to this, I would argue also that luxury is enjoying lower valuations than, for instance, the technology sector has or is standing on right now.
So kind of speaking about valuation, I would say it's a little bit of a growing area of concern, following essentially a really strong start to the year by several of the large luxury companies. They've reported record earnings and the share prices have responded. And there's been a little bit of a discussion in the press by the likes of Bloomberg suggesting that maybe the space has gotten expensive. So Javier, I'd love to hear your view on valuation in this sector.
Yeah, sure. We've seen those media reports as well. And I have to say that we challenge some of those valuation concerns, especially when we put these valuations against historical multiples. Firstly, I would like to say that the media seems to be obsessed with PE multiples, which we think is wrong. The luxury space, basically, the luxury companies generate a lot of cash. And also, the balance sheets of these companies have evolved. They are a lot more prudent now than they've been probably in the last 10 years. And that's something that is not captured by PE multiples. That's why we like to focus on EV/EBITDA. And on this metric, as you can see in the slide, the sector is on average below where it's been trading on average the last 10 years. also looking at the luxury market premium versus the overall market, this is also below the 10-year historical average. So this is all, this is, I think, important to highlight. This is all against the backdrop where we've seen greater resilience built by these companies in the form of more diversified, geographically speaking, more diversified customer base, which would normally actually justify a higher multiple. So at Tema, I think we cognizant of valuation risk, and it's something we take very seriously, but we're just not convinced that at this point is the key concern or the key to the sector. If we move further and we actually dig into the drivers of the share prices in the past 7 years, I think it's very interesting, this slide that we show here. So leaving aside relative valuation multiples, we see that absolute valuations have predominantly been driven by earnings growth, not multiple re-rating. Yes, share prices are close to record highs, but I think this has been taken out of context. We're not considering the strong earnings growth that these companies have delivered. So over the last 7 years, luxury share prices have gone up by an average of 11% per annum. 90% of that move is being explained by earnings growth alone, and minimally, only minimally, by multiple expansion. So again, this reinforces the point we made in our previous slide, that multiple expansion is not really a concern to us right now. And again, I'll stress, at Tema, we take valuation risk very seriously, and we do incorporate it into our whole investment process. But we're not convinced that right now this is the key to the sector.
I mean, this kind of analysis is quite outstanding, really. I mean, it's rare you see this much of the share price performance be filled up by earnings growth. I mean, if you looked at the overall S&P market over the same period, only about 65% of that is explained by earnings growth. And if you look at some other sectors, for example, technology, it's much worse. A lot of it has really come from a multiple re-rating. And I think, the point is that luxury benefits from a lot of strong tailwinds at the top level. But one of the things that we see is that at the individual stock level, there's a big disparity between stock performance. So you have some stocks that outperform a lot and some stocks that underperform. And the difference can often be between 200 and 300%. And really what this underscores is why active management is so important in a particular theme like luxury. And it basically, an index, you're exposed to this lagging tail of losing companies, and it gives you a lot of problems because of that.
Yeah, and I think I'd like to jump in here with this slide because, yes, I've mentioned earlier that in luxury, compared to technology, you're not exposed so much to disruption, but there's still pockets of disruption in the space that an index is unlikely to pick up on. I'm using here the example of the shoe market, where in the last 2-3 years, we've seen a very remarkable change in market shares between Tod's, the market leader, and Loro Piana, the brand owned by LVMH. Again, I insist, active management clearly allows you to pick up on these trends probably quicker than an index that is only basically judging investments by the size of the market cap.
Yeah, and this is the thing, right? This is what I was sort of saying right at the start. It's really important to do this kind of fundamental analysis to discern who are the winners fundamentally from the losers, and then that eventually plays out in terms of the share price performance. And this is why you can't really have an index-based approach in luxury. Indices have a lot of problems, and really the biggest issue is probably precision of exposure. So you've got the S&P Global Luxury Index here and its top 20 holdings. And what you can see is that you've got companies like Nike and Lululemon in there. And these have a higher weighting than some classic luxury companies like Burberry or Moncler. Basically, the index dilutes the quality of luxury exposure and instead introduces a lot of what I would call more generic commoditized consumer exposure. based on some of our analysis, more than 25% of this particular index is actually exposed to just consumer stocks and not luxury stocks. And kind of don't get me wrong here, Nike is an excellent company, an excellent brand, but it's hard to imagine a luxury brand that sells kind of 2.8 million shoes a year, especially when you compare it to, Hermes, which Javier was mentioning, that basically probably has restricted supply so much that it's sold in the hundreds of thousands over its entire lifetime for some product lines.
Yeah, the biggest surprise to me in that index list is probably Tesla. Tesla is an innovative company, but is increasingly cutting price to gain market share. Tesla has cut price 5 times in the last 15 months, and now some of Tesla's models actually retail for a price that is below the average price for the average US car. Ferrari, on the contrary, raises prices each year, and despite this, is seen an ever-growing wait list for its cars. I guess Ferrari embodies scarcity, exclusivity, and fueling basically ultimately that inelastic desirability. And Tesla, I think, from what you've shown, Yuri, is a greater percentage of the index than Ferrari is.
This is the thing, and it's not just kind of indices, right? If you wanted to buy luxury stocks directly from your brokerage account, you wouldn't actually be able to do that. So unlike other sectors, luxury tends to be listed mostly in Europe, and it doesn't have what are called sponsored ADRs listed in the United States. So if you wanted to have exposure to this theme, which hopefully what we've described to you is got exciting growth opportunity, has some interesting companies within it, you wouldn't be able to do that. So you wouldn't be able to buy the largest company in Europe, which is LVMH, on any retail trading platform in the United States. And this is kind of part of Tema's mission as well. We're here to offer access to these interesting quality companies that you might not be able to access yourself directly. So I think it's probably a good time to tell you a little bit about Tema's ETFs. But before we do that, I think it's time to do a bit of a brave poll for us and ask you a specific question.
Okay, great. Yeah, we have one more poll question. And the question is, are you looking to add luxury goods equity exposure in 2023? And the options are yes or no. And again, at any point in time, if you're interested in scheduling a one-on-one meeting with Tema ETFs, please click the blue confirm button in the meeting request box on your screen. So that question again is, are you looking to add luxury goods equity exposure in 2023? And the possibilities are yes or no. Okay, so we'll just give it a few more seconds and then we will share those results. Okay, looks like we've got a pretty good turnout. Okay, wow, it's pretty even. So I'll turn it back to you, Yuri.
Probably the best result where I feel not as upset at everything that we've talked about before, but also excited about the opportunity of convincing people in terms of increasing their luxury goods exposure. I think let me turn over to the next slide and kind of tell you a little bit about Tema itself. So Tema, just like all the ETFs that we have here, about the Tema Luxury ETF. The luxury ETF, just like all the ETFs we have at Tema, is managed by what I would call an expert team. You've heard a lot from Javier today. Javier spent a 23-year career looking and focusing and researching companies. And he's done that at a lot of top-tier investment institutions and banks. And he's actually supported by an analyst, and her name is Chong, and she's been covering luxury stocks for her whole career at Goldman Sachs and at Balyasny. So essentially, you're in good hands when you're thinking about focusing on the luxury sector. The other thing is that Tema employs what I would call a consistent and relatively simple investment process. The objective is to harness the best of stock picking skill. So what we try to do is we try to focus on bottom-up security selection, which is what you see there highlighted in the lighter color. And around it, we wrap what we call a kind of risk-managed systematic approach. The idea is that what we want to do is we want to harness the absolute best in terms of stock picking and analysis, which is where we believe active management can really contribute and add value, but make sure that we have risk managed parameters around that so that the investors get a really good outcome in the end. And the focus really here is it's on fundamental analysis of the equities.
Right. So if I can talk a little bit about our side on Tema, I just want to basically describe how we assess companies based on 4 key pillars. The first one is the operating base, where we ask basically ourselves questions about whether this is a good business model, whether the returns on capital are appropriate and high, whether the growth is there, and most importantly, whether both of those metrics are sustainable in time. The second pillar is balance sheet and cash flow. And by that, what we mean, obviously, we look at the cash generation of these businesses. In general, in the luxury space, it tends to be very good. But on the balance sheet, we use that as an assessment of downside risk. We see balance sheet as a source of problems, and we forensically analyze those balance sheets to try and minimize downside risk. Again, we're looking for companies that have a prudent balance sheet structure and with a reasonable amount of debt, or ideally not very little debt. The third pillar is valuation. Here's where we build a whole array of valuation metrics, which we compare against fundamentals, historical multiples, other peers, etc., etc., etc. So what we try to do here is to build the valuation case. And as I was saying earlier, when I talked about valuation for luxury, we take this step very, very seriously. As I've argued earlier, we don't see it as the key to the sector right now, but it is a fundamental part of our investment process. And the fourth pillar is basically, we ask the hard questions. We ask ourselves, what is our age? How is our view different to the market? And essentially, we do not invest in companies that don't tick the box in all of these 4 pillars. And supporting all this is rigorous fundamental analysis. So at Tema, we try to build conviction behind the names we invest in by going into the detailed bottom-up analysis. And that involves building an infrastructure that allows us to forensically analyze cash flows, balance sheets, industry data, and build their relationships with industry participants.
So it's quite fascinating what you do here, Javier. You're looking at monitoring and analyzing the companies that you're investing in, listening to what the companies are saying, looking at building models. And when you're doing that, I guess one of the things that you must look at a lot is kind of the risks of investing in the luxury sector. And I think it's very, very important that we talk about this for investors. How would you describe the risks in investing in the luxury ETF or the luxury sector? And how do you sort of deal and mitigate some of these risks?
Yeah, sure. So we identify different risks, but what I would highlight right now, obviously, the first one is a potential economic downturn. I mean, we've had the press, all economists predicting the next downturn. It might be around the corner. We monitor with the dashboard of macroeconomic and alternative data this risk. But ultimately, I think what the increased diversification of the customer base in the luxury space has allowed us to do is it offers now the opportunity to us to adapt the fund exposure so that we can basically avoid those regions where the economic downturn risks are greater. And this is very different to what we had in the space in luxury, say 15 years ago, where the dependency that the sector had on the revenues and profits in the Western world was massive. Today, Asia represents a much larger proportion of the pie of the market. And that allows, barring a full-blown global crisis, that allows us to kind of be more tactical. which we couldn't, I think, a decade ago. The second risk factor is disruption. I've mentioned earlier, I think this is a much lower risk than, for instance, it would be in technology, but there are pockets of potential disruption, and we try to be very close to the market to try and be able to assess those risks in an optimal fashion. Ultimately, what we're looking to do here to mitigate this risk is to invest behind firms that have a good track record in capital allocation to capture new trends. This is key.
So I guess despite these kinds of risks, we generally think luxury is a good allocation for your portfolio. If you think about it, if you were to take the global market cap of all stocks in the world, and you were to look at what percentage luxury stocks represent for that, it's about 5%, which is a surprising number because a lot of people don't have exposure directly to this fast-growing sector. And if you run a little bit of portfolio analytics on it, you look at specifically luxury stocks, you see that although they have a slightly higher standard deviation, and that tends to happen actually if you narrow down a group of stocks, the returns more than compensate for that extra risk. And so you have an improved Sharpe ratio when investing in luxury stocks. The thing is, it's essentially a positive addition on risk-adjusted terms to a portfolio. So I think on that note, we might just wrap up this part of the presentation. But before we do that, Javier, it would be great if you could maybe say 3 key takeaways from this discussion for investors.
Yeah, so if I was to highlight 3 messages or 3 key takeaways I'd like our audience to take with them, I think the first one would be that fundamentally, this is a growing industry with a increasing addressable market that just keeps getting bigger. So there's fundamental growth long term. The second message I would like you to take with you is that valuations aren't demanding for the reasons I exposed. And the third one is that an index is not the optimal way to invest. Again, we think active management has a role to play here.
Great, and I think with that, we'll open it up to questions.
Okay, great, thank you. As a reminder, materials can be found in the documents folder at the bottom of your screen. We appreciate your feedback. Please take a moment to fill out our brief survey, also located at the bottom of your screen. Our speakers will be taking advisor questions. Please type your question in the box under the slides window, and we'll get to as many of your questions as possible. In the event your question is not answered on today's webcast, a member of the Tema ETFs team will reach out to you directly. If you would like to have a conversation or further discuss the ideas that were covered during today's event, please click the blue confirm button in the media request box on your screen. With that, let's go ahead and take our first question. All right. So here is a good question. What happened in the last recession across the across the different luxury goods segments? Wouldn't luxury brands suffer in a recession?
Shall I answer that question, Yuri?
Yeah, go ahead.
Yeah, very good question. So we're all thinking about the global financial crisis, of course, 2008, 2009 as the last recession, but we've had other luxury goods recessions in between. We had the anti-graft clampdown in China in 2014. We had a slowdown in 2018. So there's been several slowdowns that the sector has been confronted with. And I think, as I highlighted earlier, the more diversified customer base has allowed probably some of the companies or some segments of the space to actually avoid those recessions. If you look at the global crisis in 2008, 2009, we did see a contraction of demand, like it was the case for most sectors. Now, that contraction of demand was very localized in several segments. So we found, when you look at the data back to the companies, what they reported at the time, you'll find out that some subsectors actually didn't see much of a contraction in demand. And here I would highlight leather goods. Sales of leather goods never contracted through the recession. We did see some fall in sales in luxury spirits, but it was mostly driven by destocking rather than a contraction in retail demand. So spirits ended up performing more resiliently than anybody expected. There are other sectors within the segments within the space that did see more protracted or more sharp contraction, and that would include things like, for instance, beauty products, some of them professional products, like in the beauty space saw some contraction that was significant. Hard luxury, so expensive luxury watches and jewelry is normally more cyclical than other spaces, but it really changes a lot by segments in the or subsectors within the space.
All right, great. Thank you for that. So next question, how can you define risk management in a luxury space?
Probably that's a question for you, Yuri, as the Chief Investment Officer.
Yeah, absolutely. I think where Tema's approach is very, very different to some of the other ETF issuers in the marketplace is that we take risk management very, very seriously. What we try to do is we have multi-layered risk assessment, right? We have the fund manager who's looking at their particular theme, understanding the drivers, understanding what's happening in terms of dynamics fundamentally in the businesses and how that translates into share prices. So I guess that's the first layer of risk management. Then you have the CIO, myself, who provides a level of oversight and challenge for some of these ideas and positions, and to really understand, are we taking the right risks? Are we understanding our exposures? What's going on in the portfolio at every given day? Then we have operational level risks where we monitor from many different directions everything that's going on in the portfolio in terms of the trading, what's going on in the market, our market makers, and all of these things. And I think this kind of three-pronged approach with multiple eyes on, particularly on risk management, is what really gives this powerful combination. I think the analogy I would use is probably one of a parachute, right? If you jumped out of a plane and you had one parachute, your chances of that parachute failing is 0.01%. But if you jumped out of a plane and you had two parachutes, the risk reduction of having two parachutes is multiplicative. The probability is much lower. It's 0.01 multiplied by 0.01. And so what you get is kind of multiple levels of risk monitoring. And that's how we think about risk management at Tema from this perspective.
All right, great, thank you. Next question, how do you think luxury brands will perform relative to vice stocks such as alcohol, tobacco, etc. during a recession?
Right, so we do have part of those vice subsectors in the space. So alcohol is part of the luxury spectrum of companies we can invest in. And as I mentioned earlier, in the last global recession, we had a spirits sector that was very resilient. So if you compare that with leather goods, well, I don't think it would be more resilient. Leather goods actually performed in a very similar fashion or even better. So we never saw demand for leather goods from either LVMH, Hermes, or any of the other competitors contract as the overall market. So if you compare it to hard luxury, as I said earlier, so watches, jewelry, the experience of the last financial crisis would suggest that segment is more cyclical than alcohol or tobacco.
Okay, thank you. Are there any leading indicators or any key leading indicators that you follow that can flag a contraction coming in the sector?
Well, can you repeat the question? I missed that. Sarah, please.
Oh, sure, absolutely. Are there any key leading indicators that you follow that can flag a contraction coming in the sector?
Yeah, so, I mean, the usual macroeconomic indicators, but I think what we try to follow closer is what is happening in the trade, right? There are a lot of forces at play. So you can be caught in the middle of a destocking trend, which is not necessarily driven by contracting demand. We try to identify those issues by staying close to industry contacts and the trade, right? One would normally think unemployment potentially rising would be something that hits the space. But again, going back to the last global recession, what we found is that the sector overall was relatively late cycle. The people or the high income profile of the customer, of the average customer, means that they tend to be late into the cycle. They tend to be less impacted by the general macroeconomic factors that would normally point to recession. They don't necessarily act coincidentally.
Okay, thank you. All right, so many of the companies are family controlled. Do you see this as good or bad for the investment case?
Yeah, I think we generally like companies that are family owned for two reasons. One, the interests of shareholders are very well aligned normally with these families, and they tend to take a lot of the decisions with a long-term view. They don't worry so much about the quarterly earnings, whether they're going to make the number or not. If they have to basically miss on some guidance metric they've given because that's the right decision for the brands and the business, they will go ahead with and do that. And that generally is good. It's a good thing for the company medium and long term. The second reason I would say, and it's a bit linked to the first one, is that because these companies are family owned, they tend to have a higher pain threshold. So when you go through a difficult period, again, even if I showed in the presentation how the gross margins provide stability to the business compared to a business that maybe operates on thin margins, they nonetheless, they will suffer through more difficult demand conditions. And what we generally find is that, again, they don't try to save the P&L. They have a pain threshold, as I would call it, that is greater. They keep on investing behind the brands through the difficult periods. And again, that tends to be beneficial for the company medium to long term.
All right, excellent. Thank you. Next question, is there much consolidation left in the industry? Do you position the fund with this in mind?
Yes, so the answer to that question is yes, there is scope for consolidation. And whilst we don't just invest in a company with a speculative angle in that we expect maybe that there's some potential acquisition from a bigger player, we do keep this in mind. Normally, what we actually find is that it is interesting companies with very healthy financial metrics, very good outlooks in terms of growth that tend to be the targets of bigger players. So they tend to go together. And we do have some of the companies that could potentially be acquired or be acquisition targets in our portfolio. You may have seen recently the speculation around Richemont potentially being taken out by LVMH. That could happen one day. Do we own that stock simply because they can be taken out? No. Would it be a nice outcome? Of course, yes.
Okay, thank you. What are your thoughts about the luxury market reopening in China?
Yeah, well, we are very positive about it. I mean, what we are seeing from the companies, from the trades so far is all very encouraging. There's been some media reports that the recovery or the reopening in China, it might not be going or being as strong as expected, but I think this is more localized to the manufacturing sector. What we've seen so far in the consumer side of things, and in particular in luxury, is that the demand is coming back very strongly. Now, we'll see whether the template to follow there is what we're seeing in the Western markets, or the Western economies, where the huge amount of savings that was built through the pandemic has been long-lasting in terms of the expenditure we've seen in the sector over, I think now, more than 18 months, probably 2 years. In China, the amount of savings that consumers have amassed is quite staggering. It could potentially lead to very strong follow-through demand. We'll see if that happens. We are positive about it, but we're cognizant, of course, of any potential risks in terms of slowdown. But so far, every single signal, every single message that we're getting from all the companies and the trade is that the reopening is going very strongly so far.
Okay, great. So how does a long-term rising rate cycle correlate to luxury markets?
Yeah, good question. I think the correlation is probably not as strong as you would expect. A lot of these goods are not necessarily bought on with financing. So eventually there might be a correlation with a lag for the reasons I explained earlier. But generally, the average consumer, as I said earlier, is a high income one, and they don't tend to be impacted in the immediate term so much by rising interest rates.
Okay, excellent. Thank you. Will you hedge any exposures?
I probably should take that one. No. So as an ETF, we're not going to be hedging, or the ETF won't be hedging any exposures. So we'll be buying the underlying equities, which is something that you basically can't do directly from many brokerage accounts in the US, and we'll be holding those on behalf of investors, and there will be no hedging. So the fund is exposed to the underlying equities and also to the currency exposure. We of course, manage all of these exposures carefully through the CIO oversight meeting that I kind of explained earlier. We watch all of the exposures carefully and make sure that we're not taking any undue risks where risks aren't required or don't have the commensurate return.
Okay, thank you for that. Which company is currently the largest position in the ETF? Do you see that changing as we inevitably head into recession later this year?
So two of the biggest positions we have are LVMH and Hermes. Obviously, we will keep our eyes open to everything that comes with the next recession, whenever that is. But the one thing I would highlight of those two names is that they tend to produce the majority of the revenues from the leather goods category and accessories category, which, as I explained earlier, proved to be very resilient in the last financial crisis. Those divisions overall never saw a contraction in revenues through 2009, 2010. So that's something to bear in mind as we enter more uncertain times.
All right, thank you. I think we have room for one more question, time for one more question. Where and how are luxury brands concentrated geographically, manufacturing concentration versus sales concentration?
Yeah, very good question. They tend to be exporters. So a lot of the companies, it tends to be that Europe is a very big exporter of luxury, and I think that gets reflected in the names in the space or the names in our fund. So you've got a lot of concentration of manufacturing capacities in France and Italy. This tends to be very kind of, when I talk about manufacturing, you must not think about big factories mass producing. It's very craftsmanship like facilities, right? So this tend to be, if we look at the space, this tends to be concentrated in Europe and particularly in France and Italy. In terms of the sales, I mentioned earlier, for instance, Hermes, one of the big companies in the space, generates around 60% of the sales now in Asia Pacific. So I would say that with China and Greater Asia expected to become as large as 50-60% of the luxury goods market globally, that part of the that geography is likely to become increasingly important. Today, if I think about the top names in our portfolio, basically we will have a relatively even split between Asia, Europe, and US in terms of sales revenues.
All right, thank you for that. And thank you both for such an informative discussion. As a reminder, materials have been made available for download, can be found in the documents folder at the bottom of your screen. We appreciate your feedback. Please take a moment to fill out our brief survey, also located at the bottom of your screen. If you would like to have a conversation or further discuss the ideas that were covered during today's event, please click the blue confirm button in the meeting request box on your screen. Thank you so much for joining us and enjoy the rest of your day.
Thank you.